Hey there traders, hope you guys are doing well. So in this video guys, please watch it till the end, okay, because I'm going to be showing you the strategy that I used this week to make 8k in the markets. Okay, I'm going to show you from start to finish how it works, just basically trading the high, how to learn how to trade off of the high of the day and the low of the day, guys. It's an insane strategy that'll generate you insane like weekly profits. Okay, please watch it until the end and you're going to be mind blown. Another thing is, guys, please subscribe and please like. Okay, please subscribe to the channel. Also like the videos. A lot of you watch and don't subscribe, so please guys, watch it till the end. It's going to take your trading to the next level, guys. It's going to take you from being a really poor trader to actually understanding the markets and liquidity and all these basic things, stop hunts, breakouts, and it's going to take your trading to the next level, guys. Catch you on the inside. I'm just going to go over a strategy that I use week in and week out to generate crazy profits in the markets. I'm just going to run over it quickly. So what it is trading from the high of the day or the low of the day, all right? And the benefits of trading the high of the day and the low of the day. So this gives me the high of the day and the low of the day for each session. As you can see over here, marked in gray, these are the session breaks. So this is Monday, Tuesday, Wednesday, Thursday, Friday. So these are basically just the session breaks. So how do I get this indicator? So if I remove it here, just come into indicators and type in high and low. So the one that I use is this one here by H. Potter. Now I modify it just to thin it out a little bit. So you can see over here, I just thin out the lines. Okay, just so it doesn't overwhelm the chart. I don't know why that didn't change. Okay, so now they're nice and thin. So understanding what you need to understand about the high and the low of the day is that the first thing is breakout traders are now in the market, and what you need to understand is that most breakouts fail. Okay, the second thing is stop hunting is occurring, so stops are being hit. And the third thing is liquidity is being generated. Okay, let's start with the first thing. Breakout traders are now in the market. So what do I mean by trading off the high and the low of the day? What I mean is, as you can see with this day over here, we have the high of the day and we have the low of the day, right? So what I do is I come into the market and I'll mark out the low of the day and the high of the day. So all you need to do is mark out the high of the day and the low of the day. Just like this. Now as you can see, the high of the day gets taken out. Now what's happening during this process is that breakout traders are now in the market. So going back to the first one here, breakout traders are now in the market. Most breakouts fail. Okay, you'll notice that most breakouts fail. Okay, so if we just drop down to say a 5-minute time frame, when we are to zoom in a bit on this. Okay, so the market makers know that breakout traders are now in the market, and at the same time they're doing a stop hunt. Okay, so if you look at what I've written here, stop hunting is occurring, so stops are being hit. Okay, liquidity is also being generated. Okay, so you can see over here, liquidity stops are being hit, breakout traders in the market, so there's a very good reason, there's a very good chance that the market's going to reverse. As you can see over here, the market makers basically do a 16 or 17 pip stop hunt. As you can see, a 16. So when there is a breakout, what's normally happening is the market makers are triggering breakout traders, but they're also doing a stop hunt, and that stop hunt is usually 20 pips. So what they want to do is they want to trap breakout traders, so they want to get breakout traders into the market, and then they normally immediately reverse the market. As I was saying before, most breakouts fail, all right, and then they'll come back inside the box. What do I mean by the box? I mean, so we got the high of the day and we got the low of the day, so you can consider this a box. And when the price is inside of the box, you don't want to be trading, all right? So you can see a price starts out in the day, it moves up and down inside of the box. So I don't want to be trading inside of the box. I want to wait first for a breakout from the high of the day, and then I'm looking to trade from outside of the high of the day back inside, normally just inside the box or towards the middle of the box, and then close the trade. Okay, It's as simple as that, guys. If you look at this, it happens frequently every day in the market. If I just remove these, we'll do another one quickly. So there's just so many, guys. If we look at, okay, so let's just do, like, for example, this day here. We're looking at this day over here. As you can see, all you need to do is mark out the high of the day and the low of the day. You can see over here, they basically, the market starts out, they trade inside of the box and they come back down, they trigger breakout traders. So the market makers trigger breakout traders right over here. Okay, and then the market reverses. And so what they basically did here, this is only a quick stop hunt. See, this was only basically a 10 pip stop hunt, and then they reversed the price. Okay, so if you look over here as well, over here, here's high of the day. Here's low. Low of the day is all the way down here. So obviously they didn't come down to low of the day, but so we're looking at this day here, right? You can see over here they come up to high of the day, they trigger breakout traders, they do their stop hunt, so they stop hunting these guys on the left. They're taking out their stops, so they're generating liquidity before they move down. Because remember what you have during a stop hunt, normally what's happening is there's an exchange of money between buyers and sellers, and the market makers are exchanging money between the buyers and sellers. They're generating liquidity to basically move the market back down inside the box. Okay, you can see the box is basically between the high and the low of the day. So basically you can see, if I just show you how frequently this happens, we're just looking at this day over here as well. We have, all we need to do is mark out the high of the day. We mark out the low of the day. And you can see over here, they come up and take out the high of the day. They take out all these sellers' stops. They trigger breakout traders. So going back to this, most breakouts fail. Stop hunting is occurring, stops are being hit, liquidity is being generated. Okay, if we drop down to like a 5-minute time frame and we just zoom in on this for the entry, so we can see here they take out high of the day right over here. They've thrown a nice pin bar. So what you'll be looking for is your price action, meaning you'll be looking for pin bars, engulfing candles, double tweezer tops, things like that. So you can see here a nice nice hammer pin bar, and then you'd probably want to enter here, and you can see a nice 30 pip move back inside of the box. So the box meaning the high of the day and the low of the day, so they come back inside the box. So it's pretty simple. It's a simple strategy. What is the benefit of this strategy, guys? Why do I like this strategy so much? Because, so if we look at the benefits, it prevents over trading, so it makes you wait, it makes you sit on your hands for setups, and it also offers you a high probability trade setup. Okay, that's basically the benefits of this. Okay, and it gives you a really high probability trade setup, as I said. So basically you need to understand, all you need is the high and to understand the high and low of the day. Understand these three concepts, that breakout traders are now in the markets and that most breakouts fail. Okay, so you never want to be trading inside of the box. So basically for this was for yesterday. All we'd be doing is marking out the high of the day and the low of the day. And we will be waiting for the price to do something like this, trigger stops. Okay, so stops are going to be hit. So these stops are going to be hit. Breakout traders are going to be in the market, and we know that breakouts normally fail. And we'll be looking for a double top or price action showing us that price is going to come back down inside the box. All right, so that was for the top side. And we can see for the bottom side, what we'd be waiting for is price to come down, trigger breakout traders, allow them to do, you know, a 20 pip stop hunt. Okay, and then the you know, from this level somewhere around here, the price will bounce off some sort of order block looking left, and it'll return back inside of the box. Okay, if it does fail, if they, for example, if it does come back down, they might be going all the way down to this level over here. Okay, they might be coming down for that liquidity. So bear in mind, if the breakout continues, that's why you need a stop loss in place, because they may be coming down to generate liquidity from down here at this low of the day, or possibly they might just come down to this low of the day here. Okay, so if it fails, it means that the market's going to trend. It's going to go down to one of these areas of liquidity. So you have to have a stop loss in place, because most of the trades are going to work, but the trades that don't work, you need to get out quickly and then reserve your capital for another setup that's going to make the loss back and a little bit more, all right, or a lot more, so that you can be profitable. Remember that trading's a game of, it's not just a straight. Okay, well, one thing that I had to understand is that trading is not like this. It's not just straight up like this, right? It's understanding that an equity curve is like this. Okay, it's not a straight line up, it's going to be jagged, all right? Profitability is jagged, it's ups and downs, all right? That's a concept that you have to understand. Okay, you have to understand that losses are part of the game. That's why you have a stop loss in place. Okay, so you have your stop loss in place. Now you have a 10 pip stop or 5 pip stop, however. Your risk is really up to you. I prefer to use between 5 and 10 pips, because I'll be trading setups like this on the 5-minute time frame. Yeah, we're looking for an entry off the 5-minute time frame. So you can see over here, they take out liquidity, they trigger breakout traders. Let me just, and then they come back inside the box of the low of the day and the high of the day. So you can see over here that they give a nice pin bar up here. So this is the price action that's showing us that they're ready to drop it now. Okay, you can call this a fair value gap or whatever. I don't really believe in ICT concepts and all that. But you can see over here they basically did a 16 or 17 pip stop hunt, and then they reversed the market. So it's key to just wait for the high of the day or the low of the day to be taken out, and then you look at your setups, taking your setups from there. So take a screenshot of this, backtest this by yourself on all of the pairs. You'll see it's high probability. It happens over and over and over again. Okay, and it's going to take you from being a shit trader to a profitable trader in literally a couple of weeks once you understand this concept. But another key thing is to understand price actions. So understand pin bars, engulfing candles for the confirmation of when they're going to come back down inside of the box. Take care, guys. Hope this video helped, and I'll catch you in the next one.